There is no cookie cutter solution. It's not a one size fits all, it's a one size fits one. So, those advisors or private wealth advisors I talked to you about earlier, every client they have they may be similar, but what client A needs can be completely different than what client B needs.
Don, thanks so much for joining me.
Ted, good to be here with you.
I'd love to have you take me back and just walk me through your path that led to you being in this big seat you're in today.
I call myself the accidental executive, quite frankly. So went to the University of Florida. I'm from a small town in the state of Florida. Always thought I was going to be a lawyer. But when I was graduating from college, all my friends were going that direction. So I said, why not do something different? And decided to become a stockbroker at the time. Now we call ourselves financial advisors. Think I had somewhat of a successful early career. Was asked to get into management, into leadership. Fast forward 34 years later, and I now lead the private wealth business for UBS here in the Americas.
So take me back in those early years and through what you saw in the evolution of, well, today we call it private wealth, but from stockbrokering to what it is today.
Back in the late 80s, early 90s, it was really all about equity selection, buying stocks, building positions, trying to make our clients money through buying the right equities. And then the industry really evolved to more, asset management, fee-based solutions for our clients. For some reason, I was always an early adopter. So I was the first person involved with managed accounts. And I was one of the first people involved with looking at estate planning insurance solutions. And to me, the consultative kind of view of the business, which was much more appealing to me than let's say the individual stock picking. So because of that, I guess I was thinking in the future, and that became the future of our business. So much of our business now is tied to asset allocation, using managers as a proxy to picking individual stocks, using indexes and charging our clients an advisory fee as opposed to a commission per transaction. So early into that kind of led me into trying to lead other people in that direction. And here we are today. And we've also at the same time, we've seen our clientele become extremely wealthy, especially in the last 15 years since QE, frankly. And, what I noticed back at that time when interest rates are sitting at zero for a period of time, wealthy clients were going to get significantly more wealthy faster. And when there's zero cost to borrow and you already have assets, regardless of what's happening in the markets, you can redeploy those assets. You can buy businesses and borrow to buy those things. And so at basically zero. So what we saw the last 15 years, which is this enormous growth in wealth in the United States and globally, frankly, but in the U.S. in particular. And so during those times, I found myself gravitating towards those complex situations with those clients who are accumulating wealth quickly and what to do and how to help them with those situations. So that's how we went from, being an advisor from a small town trying to figure it out to now working with some of the wealthiest people in the United States.
The path of accidental executive, what were the most important steps for you in that path?
Well, I view my job as really a leadership position. So, and I love the business. I love clients. I love working with financial advisors. I love directing strategy to try to think 5 years ahead, to try to put our advisors in the best position and our clients in the best position. So, I love the leadership principle of it. And I have, hundreds of private wealth advisors that report into our business here at UBS in the Americas. I think of it as like the special forces of our UBS Army in the United States. And I think we're really good at what we do. And so the passion of me to help people grow professionally and help their clients do, even better is what drives me at this. I tell people all the time, my job is to help our clients do better for themselves, so our advisors do better for themselves. And it's, by the way, that's the order. If we help our clients do well, our advisors do well as well. It's like one large partnership.
When you look today, what is the size and breadth of the platform that you're overseeing?
We'll take a step back and just look at the UBS platform from a large perspective. And I think that's really our special sauce, quite frankly. We're the world's largest global wealth manager. So we manage on our wealth platform alone over $4 trillion. If you include our asset management company, we're over $6 trillion of wealth around the world. 2.1 trillion of that wealth sits in the United States. So we're a very large wealth manager in the U.S., but also globally as well. We're the largest wealth manager in Asia. We're the largest wealth manager now in Latin America after our Credit Suisse acquisition. And we're the fourth largest wealth manager in the United States based on assets under management from wealth clients. Also the largest wealth manager in EMEA. So that global perspective and insights and the ability to connect clients and learn from clients regardless of where they live, I think is really, like I said, this kind of the special sauce of UBS. For example, if we have clients in the United States that are looking for insights from someone in Asia, or maybe they want to start a business in Asia, we can make those connections really quickly. And, I say we have boots on the ground everywhere in the world, and we have clients on the ground from everywhere in the world. And so that's the exciting thing about our business. Now, in the U.S., $2 trillion of assets under management, about 60% of those assets, just a little under 60%, are in ultra high net worth assets. It's been the fastest growing client segment that we've had at our firm for the last 15 years. And so we classify clients in different segments. We have core affluent, mass affluent, high net worth, and ultra high net worth. I get to oversee the part of our wealthiest client segment here at the firm. And it ranges from anywhere from a business owner that just happened to sell their business and now they're wealthy, to some of the largest families, and their family offices in the United States, and trying to help them navigate the complexities of the investment landscapes out there.
So that on the client side gives a sense of this incredible scale. How about the advisors?
We have 661 what we call private wealth advisors. Those are the advisors that primarily focus on the ultra high net worth client segment. You have to have some certain criteria to qualify for that. In other words, you already have to have a certain number of ultra high net worth clients in your book of business. And then you have to go through an accreditation program that we make all of our private wealth advisors go through. And so we have 661 of those. That's comprised of 230 teams. Most everyone's on a team now because what I found is this is a team sport. Really hard as an individual to kind of manage, once again, the complexities for our clients. So part of it's about investments, but a large part of it's about helping them with the complexities of everything else in their life too.
So I'd love to understand how you organize all this. So there's the U.S. piece, there's this global piece, and you mentioned, you should be able to have access to information, but if 660 teams just in the U.S., how do you even start to think about how this all comes together?
We have different managers in locations around the country, and managers will report into us. And so it sounds complicated, but it's really not, because everyone kind of reports into another channel, and that channel may report into me. So it's fairly simple. Globally, I have people around the world that do what I do. And so we have regular communication and contact, and very collegial. I mean, it's, for me to pick up the phone and have a discussion with someone in Asia or the Middle East is very simple for us to do, once again, because of the collegial nature of our organization. So sounds complicated, but it actually comes together pretty well. And by the way, I've also been running this business for 14 years. And so maybe I'm simplifying a little bit more than it needs to be, but the relationships that I've built both internally with our internal stakeholders in the organization, as well with our financial advisors at the firm, and also our external stakeholders, our partners and asset managers that we work with, probably makes it a little bit easier for me.
So when you go from that highest level to where you're sitting all the way down to the individual client, you can imagine there's a need for both some standardization on the investment side and plenty of customization. How does that all happen?
It's really hard. So a couple of things is we are an open architecture platform at UBS in the United States. So we can talk about different, products and services and asset managers until we can't talk about them anymore, because we offer just about everything for the most part. We have our own internal UBS products and services as well. We have our asset management company, which frankly I think is one of our crown jewels. But our advisors aren't required to recommend that to their clients if they don't want to. It's whatever they think is the best possible investment for the best possible price for the client at that particular time. So we're completely agnostic. In our private wealth business, we kind of have this foundation that we try to build everything off of 3 words: personalization, specialization, and customization. Now, that's extremely hard in a wealth management business that's very compliant driven. We have a lot of regulatory requirements we have to work under. But at the same time, we have to be competitive in the marketplace. And so everything we do has to be about how personal are we getting with that client and what they're trying to accomplish, okay? Now, that sounds like that's kind of simple, right? Everybody is, but it's not. There's a lot of cookie cutter approaches to the wealth management business today. And I'm here to tell you, especially in the ultra high net worth space, there is no cookie cutter solution. It's not a one size fits all, it's a one size fits one. So, those advisors or private wealth advisors I talked to you about earlier, every client they have they may be similar, but what client A needs can be completely different than what client B needs. And so it's that deep personal attachment to them. And then the specialization, which I think is some of the secret sauce of our business here in the United States, is many times our advisors are going to bring in internal specialists to talk about things like trust and estate, or philanthropy, or family advisory, or alternatives, or asset allocation. They'll bring these experts in as an internal third-party subject matter expert to speak with their clients. I am convinced that specialization is critical because clients are smart. And if you bring someone here that's not really a specialist, but they claim to be a specialist, but they're really a generalist, the clients aren't going to say anything to you. They're going to smile and say thank you, and they're going to walk out the door, and they're going to go find somebody who's a real specialist. So while our private wealth advisors in many cases are kind of generalist in how they approach the business, they bring in these specialists. And so we have an army of specialists I think are the best in the business. For example, we have over 30 trust and estate attorneys. At UBS, we don't outsource this stuff. We only outsource if we feel like we can't do it internally. Most everyone an advisor will put in front of their clients is a UBS employee. And in many cases, the buck stops with me. Clients like that. And the third leg of stool is customization. We have to figure out how to customize the relationship because that's what the clients expect from us, right? They expect some level of customization, whether it's something that they need a special report, right? Now we'll have to get that compliance approved, which is, we're in a highly regulated industry. But if our control partners are comfortable with what we want to do with our clients, they're great partners to have. Now, when you run a large wealth management business, you have to have a lot of consistencies, right? You have to keep it right down the middle in most cases. And so my job as the leader of the organization is to try to find ways to operate within it, but to create that personalization, specialization, and customization.
When you hone in on just the investment part, so alongside all the services, where do you centralize and where do you allow the decentralization of decision making?
Our advisors are, what I love about them is they're almost like independent contractors. They work for UBS, but they're entrepreneurs. They have their own styles and philosophies. Now, we have guidelines and, guardrails, so to speak, in terms of what they can recommend to clients, but they'll follow our chief investment office kind of strategy, but they always have their own kind of twist to it. Right? They all have their own kind of one private wealth advisor may have a different kind of overall strategy than the advisor in the office next to them. And by the way, we think that's what makes us great. It's that entrepreneurial spirit that they bring to it. But more often when they bring in our specialists to talk to their clients about strategic asset allocation or the right alternatives to put in a portfolio as you build it out, we build a little bit more consistency into the overall offering.
If you look at say an individual advisor, maybe they're new and they're coming onto the platform. What is the CIO office telling them today about what they believe those guidelines are for serving their clients on the investment side?
Especially today, we're talking about times of extreme volatility and uncertainty out there. And I think our chief investment office has done a great job of let's stay the course. This is not the time to make major changes. Unfortunately, clients sometimes want to. We become the psychologist of our clients. I tell people that all the time. And so stay the course. If you have the right plan in place, you may want to tweak that plan, but you don't want to drastically change the plan. And, history has told us that the S&P is going to return around 10% a year. It's done, last couple of years, it's returned over 20%. Maybe there's some regression to the mean right now. I view that as buying opportunities. And so, I think the steering of our CIO office is, let's make sure we're allocated properly first, and then let's make sure we pick the right investments second, and let's don't panic. We're trying to be pragmatic about it, understanding that, when markets are volatile like this, clients get nervous. But if you take a step back and think longer term, maybe the world feels like it's falling apart right now, but there's been other situations where the world felt like that too. And so we're trying to help them think about it. And one of the things that I always try to do to kind of, put our CIO advice in perspective is I always kind of give my 5 themes every year about, at the beginning of the year. And I try to think 5 to 10 years out. I'm not a futurist. I can't predict this stuff, but I'm pretty good at following demographic trends and understanding what interest rates do and where wealth is and how markets have reacted. And what we knew 2025 was going to be a year probably to reset, was going to be a year it was going to be tough. And we're going to have to manage expectations for clients because the previous 2 years had been so good. And we had the euphoria of the presidential election and markets ran up at the end of the year. It's like, okay, well, this is going to be a tough one this year. And so trying to manage early so you're not completely surprised when it happens.
So if that's one of the themes, what are the other 4 that you're out talking to the teams about today?
That's one, is 2025 was going to be a year to be tested. The other 4 themes are really long-term. The second one, which has always been my second one, is the family is always the major issue. It's all about family. And so if you think about this whole demographic kind of shift we're going through right now, is most of the wealth in the United States of America is in the hands of baby boomers. There were 77 million baby boomers on the planet. Today, there's probably, depending on who you ask, probably around 70 million baby boomers because they're starting to die, born between 1946 and 1964. The youngest baby boomer is 61 years old. The oldest baby boomer is 79 years old, somewhere in that range. But the average baby boomer is in the upper end of that. So what happens is, this kind of baby boom generation is like that big, what they say, the pig going through the snake. And their wealth continues to grow, even though there's fewer of them, but they're in the wealth accumulation stages of their life, about to go to the wealth distribution of their life. And so, depending on who you look at, 60%, 70% of the wealth in the United States is in the hands of those people. And so that's not going to change anytime soon. So we have this great opportunity to help them make sure they manage their wealth and how to make sure they distribute it properly, like how to get it in the right hands at the right time and how to make sure that their kids are financially responsible and their Generation 3 is financially responsible. If we focus on that over the next 5 to 10 years, it could be the greatest 5 to 10 years in the industry for a financial advisor, quite frankly. At the same time with that group, they're going to live longer. So our job is to help them have enough assets to make sure they don't outlive their money. We want their money to outlive them. And you would say, well, you deal with really wealthy clients. How can that happen? It happens all the time, right? And so we have to think about, you're going to live longer than that you originally thought you were going to live. There's going to be medicine. There's going to be drugs. There's going to be everything that's going to make you live longer. So how do we as financial advisors make sure you're prepared for that today, so it's not a surprise in 2035 because they're going to be alive then. So that's number 2.
On that second theme, what do you do differently in the investment side of the house, knowing that, let's say, the assets have to have longer duration than they used to?
We have to make sure we can maintain a competitive rate of return. We have to outpace inflation. Inflation's for real. But many of these clients don't want to take undue risk either, right? They've made their money. Sometimes I tell people, you're the alpha generator in the equation because that was the business that you started. Our job is to preserve your wealth and make sure you don't blow it. But preserving wealth doesn't mean just to buy a fixed income security and hold on to it for maturity. Preserving wealth is to make sure we preserve it with inflation involved. And so we have to have returns that outpace inflation. At the same time, we think that we can, give you a consistent long-term return where you'll outpace, what we call the normal living standards. And so it could be, is it the traditional 60-40 asset allocation model? I don't know if that's it anymore, but But we know that we can talk to clients about thinking longer term with some of their assets, right? Maybe some of your assets you need more liquidity, shorter term, and so we'd be more conservative there. And then maybe there's intermediate term kind of time horizons on those assets for the next maybe 5 to 10 years. We can be maybe more aggressive. But what about the money you'll never need? Why don't we think about longer term investments, things that we won't need, probably will never touch, but if we do, it'll be 15 years from now, that maybe we can take a little bit more risk. Maybe we don't need the liquidity in those investments and we can create more alpha in those returns so that if you live 10 years longer than you thought you were going to live, you're still going to have plenty of wealth to live by and hopefully give away.
How about the third theme? Third
is the security of everything, meaning I think we live in a new world today. I think we've in the United States, we've lived in a bubble. It's been a great bubble, by the way, where we don't really worry about security, personal security that much. And that could be an example would be if you had a house in Los Angeles and the fires came through and your house survived, but all your neighbors' houses were burned down, but there's no one there to protect your house and what's in your house. You may have to hire a personal security guard for the next year to protect your house, or you need someone to make sure that your own personal computer system can't get hacked. And so you need the whole internet security. Everything's about security. The rest of the world's been going through this for the last 5 years or a decade. We haven't. And I think we all have to be more focused on our own personal security. And so either understanding how to access those capabilities is important, and we can help our clients do that. And understanding how to invest in those capabilities too, by the way, is important because I think it could be a big opportunity down the road. So it's all about the security of everything. The fourth one is AI. It's been on our list for 4 years now. And while is it accelerating? And, we used to talk about chat GPT. It's so much more than that. In fact, every day there's a new, AI entrant into the world that we live in. And as I tell our advisors and our clients, you have to be a user of this stuff. You have to embrace it. You have to use it. Are you using AI technology to help you run your practice better and live a better life? At the same time, it creates investment opportunities for us as well, right? Are we taking advantage of it personally, and are we investing in it as well? So we talk about trends in that space. And then the fifth is, kind of bookends my first one about this year will be tested. It's we have to find a way to stay in the markets. And, I think it was, trying to think who said this, but it's bull markets are long and bear markets are short and painful. And I don't know how short and painful this bear market is that we're in right now, but, trying to keep our clients focused on the long game and, maybe repositioning, but staying in the markets so that they can obtain those returns that they're going to need over the long term, over their lifespan. So the fifth one is kind of book into the first one, but this is a good time to reset things as well. And so those are the 5 themes that we kind of drive through.
So as you share these themes with the teams that are working with all your clients, they then have to go into the markets and implement. And I'm curious what you're seeing on the platform in terms of the shifts in investment over the last few years and what you see going forward?
Well, and especially in the ultra high net worth space, Ted, there's a larger and larger allocation to alternative investments, no question. And so what has been one of our differentiators that kind of creates some distinction maybe in our platform for our advisors is that, and we'll probably get into this, but we have, I think, a very robust alternatives platform across a lot of different disciplines, by the way. And wealthy clients were asking for that. That's where they were looking for their alpha. And frankly, a lot of them were, they like the liquidity premium. Some of them were tired of the volatility of the market. It's I don't need the volatility. I don't want to see it go up and down every day. What can we invest in that maybe we don't have to focus on day-to-day volatility? And so alternatives, obviously, through private equity and other vehicles has been a very attractive offering for our larger, wealthier clients. But now you see it becoming a little bit more mainstream, right? As long as clients are accredited or can fit the profile. You're seeing these liquid portfolios that don't have K1s in some cases, don't have capital calls. And so we've seen over the last couple of years where we're seeing the take up in alternatives coming downstream, and it's just quite frankly easier. And so the questions we get from clients today is, I don't know if I want to wait for a 15-year payoff. have in the alternative space that maybe has a little bit more liquidity, don't need daily, and at the same time maybe receive some, payoffs sooner. So we have a lot of different seasoned portfolios that we can offer the clients. But where it used to only be an ultra high net worth investment option, now it's becoming an option for many people in the high net worth space as well.
How does that platform come together? Sort of how you architect the different investment options that advisors can choose from?
Well, if you think about it, take a step back on the larger platform. So, we manage, we said $2 trillion of wealth in the United States. Our private wealth business is over $1 trillion of that. And so, it starts with just pure asset management, right? Using separately managed accounts, using indexing. In some cases, some of our advisors build their own portfolios. Most of it, by the way, is tied to a fee. Very little of our business is actually tied to commissions today. So whether our advisor uses separately managed accounts from the names that you would probably know, all the largest asset managers in the world, including some you would never know. We try to give, color all of those managers to our private wealth advisors, and then they can kind of decide on the asset allocation. So that's the foundation, right? And then you have other products and services maybe above that. And you can think of alternatives. So alternatives will be not for everyone, but they're going to be for the wealthier client segment and for the advisors looking for a little bit more sophistication and maybe alpha in their portfolio. And so we have a wide number of people in our organization that monitor managers, that decide who to bring on the platform, who not to bring on the platform. Our separately managed accounts are, continuously going through due diligence processes to make sure they're doing what they say they're going to do, and that the same management teams are in place that we hired them with, because we have a responsibility to our clients as well, right? Then you get to the alternative space, and it's a whole nother level of due diligence. Probably more risk to it. There's certainly a lot less visibility into them from a client perspective. So we have to make sure we do our diligence, because we have a duty to our clients to make sure we're not just putting anyone on our platform. We're putting people that we've done all of the work to decide, do they fit? Are there the right controls in place? Do they have the right leadership in place? And are they doing what they say what they're going to do? So Jerry Pascucci at our firm runs our alternatives platform. He runs a very curated platform over the last 15 years. That's been one of the areas, is our alts kind of platform is an area I think that we've really kind of created that distinction with our private wealth advisors. Whether or not they want to invest in it or not, at least we get to show them some very interesting alternative investments in two different areas. We could either be kind of the mainstream, big name, core holding alternatives, but there's also that unique and exclusive kind of piece to it as well. Everyone wants something a little bit different that they can't get somewhere else. And so, we have a couple of different ways to look at it on the platform.
How does that curation work under Jerry?
We're trying to think, where's the world going to be in 5 years from now? Where's it going to be in 10 years from now? Not where it is today. Let's identify the managers and the themes and the strategies that we think are going to fit in those categories. And so, once again, I'm not mentioning names. All the big name private equity firms, and they have infrastructure funds, and they have AI funds, and they have, data center type funds. They have real estate funds, which all of those are great for maybe the core holding in a portfolio. And then we have all these other managers that we try to identify that may be the new up and coming private equity manager. They may have a unique kind of value proposition and a very kind of tight window or a narrow focus that they can bring to our clients as maybe a satellite approach to that kind of core. And so I think Jerry's done an incredible job of identifying opportunities, not because it's mainstream or because everyone else is doing it, but because we think it's going to be the place to be in 5 years from now.
What are some of the rules of thumb as, let's say, Jerry and the team are looking at different investment options, knowing there's $2 trillion just in the US, let alone $6 trillion around the world, that might want to have access to whatever that special opportunity is?
Yeah, I mean, we're agnostic to size of the fund. And sometimes that creates, a queue at the window, so to speak, to get them. And sometimes that creates, clients not having the best experience because they didn't get it, or they got a much smaller amount that they originally wanted allocated towards them. The benefit of it is we are a global company and we have access to global opportunities. And so we feel like there's an endless stream of opportunities for us to choose from. And so we're not afraid to go after smaller deals that we think are very unique because we know we'll find another small deal as well, okay? But there could be something that comes from our colleagues in Asia that no one in the U.S. is ever going to have access to, or it could come from our colleagues in the EMEA region. And so we think we have a variety of options. Sometimes, once again, sometimes they're so curated, you may not have access to it, but we're pretty sure eventually you're going to have access to one that you want to do, on top of the normal names that you know that are outstanding, by the way. They're incredible partners and they do great for clients, but there's larger capacity, right? And we always have those on our platform as well.
In those situations with finite capacity, how does maybe you call it the allocation process work across the advisor base?
We'll come out early with the fund, and clients will have to submit indications of interest for it for their accredited clients, usually for these types of funds. And then we just usually go through to identify who are the clients that we know are capable of investing in these investments, who are the advisors that we know understand these types of investments, and how do we make sure the clients get their fair share. And so sometimes the smallest ones are the most in most demand, and it's hard. But once again, we know if we're going to come out with something similar, we'll try to do that to complete, and so we can fulfill the demand that we have. But, sometimes that's the scarcity issue. And, having scarcity sometimes gives me more confidence in the manager because they're not overextending themselves. And we have to talk to our advisors and our clients about it, that you may not get this one, but you'll get access to fund number 2. That's a great thing for the manager because they can allocate funds to one offering and be focused on that particular fund. And then if they know they have additional capacity, we open up another one. And it's almost like I feel like they can manage it better themselves.
From a manager's perspective who's talking to the team on the platform, how do they think about the process of educating this very diverse base of advisors?
That's the tough one. It's because we have advisors at a firm like ours and all the other firms in the U.S., by the way, that have no interest in doing alternative investments at all, right? And so how do you break through, right? How do you get anyone's attention, whether it's the advisor or whether it's Jerry and the due diligence team, right? And so, the funds have to be able to demonstrate and provide evidence that, they have a capability that's worthy of our clients' needs. And they can do that locally through our office managers. Will have people come in and talk to them. They can come directly to me. But once again, we are not going to offer any fly-by-night, fund of the days. And so the key is, can you provide evidence? Can you demonstrate, your track record? And then what are you going to do going forward? We have a pretty rigorous due diligence process. Some say maybe more rigorous than others. I'll let Jerry answer that question. But I think that's good. I think we have a duty to our clients to make sure that we do that. And everyone wants to be on our platform, by the way. I mean, when you manage, over $5 trillion of wealth from two-legged individuals primarily, and you do it globally, so you're diversified. It's not just isolated in one geography of the world. The benefit is everyone wants to be on our platform. The challenge is that we have a lot of people we have to say no to. And it takes a lot of time to go through the diligence work on them because, once again, it's a unique platform different than anyone else's in that it's globally diversified, skews to the ultra-high net worth segment.
Walk me through a manager first getting on the platform. What might their time look like in getting from not having a relationship to having a very successful and broad relationship?
First of all, they're going to have a distribution force. They're going to have I don't know if you want to call it a wholesaling network, so to speak, because our industry still is a relationship business. And you can post all the numbers you want to, but there's got to be some type of human interaction when you're talking about an illiquid, more complex investment, in my opinion. So first of all, I think you're going to have some sort of a network out there. And it doesn't have to be large, but enough for someone to, if they have a question, an advisor can pick up the phone and give them a call. So that's number one. So you have to have a network of people, wholesalers, however you want to describe them, that can actually go press the flesh, talk to people individually. What we've done with a couple of our partners here, by the way, is I'll do what we're doing right now. I'll do a podcast/webcast, and we'll talk about their fund, especially when they're just hitting the platform. And very similar about, give me a little bit of your history. How did you get here? How did you get in this fund? Now tell us about this, this sector, this scene that you're going after, and how can clients participate in it? It kind of gets broad distribution that way. But what we found is that, the most successful ones are already big and already have those networks in place. You can, once again, you know the names of all these funds. They're great. The newer ones struggle with it a little bit. Like, I don't have these people in place. How do we do it? Can you help me? We work really closely with the private equity managers and the fund managers to make sure that we can get their message out there a little bit more than just internal communications that you're going to see on our intranet, a flyer that you may see. It's, once again, I go back that we are in a people business here. And those relationships that you have will make the difference in terms of someone saying, I like that fund, and also like them because they take my call when I have questions. And that means a lot, especially in this space, I think.
If you look out over the next couple of years, there's a lot of simple math that says, and the private wealth channel only has 2, 3, 4% of their money in alternatives. The institutional channel's a multiple of that. If only a percent moves, and you look at, $2 trillion, a percent is a pretty big number, $20 billion. What do you see happening in asset allocation shifts within your client base over the next few years?
Yeah, well, at our firm, in our private wealth business, it's just about 8% is in alts. I think it should be 20. Our CIO's calling for higher than 20, just so you know. So we still have a long ways to go. And by the way, our alternatives managers know that too. It's a big opportunity for them. Our clients are, in most cases, are demanding it. Okay. Our advisors, in some cases, have to get more comfortable with it. Just look at endowments and foundations out there that have a much larger percentage. And so we think it's important for clients to get into it. The right client, by the way. They have the right time horizon. We think they can produce alpha in the portfolio. We think it takes out some of the volatility. We just think it for all the right reasons. But it's not easy to convince someone to do something when they don't have instant liquidity where they can sell it, have daily marks on their statements or online services. So we're gradually kind of getting to that spot. Now, it looks like we're kind of in a pause right now a little bit. Private equity, I think, has been difficult. And one of the reasons is volatility of the markets. But at the same time, exits have kind of disappeared right now. So, most people invest in private equity. They're hoping they're going to get some money flowing back to them in the form of exits, whether that's IPOs or, acquisitions. And certainly those have slowed over the last couple of years. And in environments like this, they have. So that could slow things down in terms of private equity take-up. So that's why you've seen a big shift into perpetual funds and late vintage funds, because we're seeing like, okay, do I want to go the traditional new private equity lock up 10-year fund, or do I want to buy a vintage fund that should all, instead of going through this whole J curve, I'm going to get the bottom of the curve right now because the curve's going to start going up. So we see vintage, perpetual, and liquid alternatives kind of filling the gap of where maybe the traditional alternative platform was. And we see all of our alternative kind of asset management partners out there coming to market with those types of programs as well.
When you see 8% today, 20% or more in the future, what, if anything, could derail that from happening?
I think a lot of it's market psychology again. I go back to we are essentially psychologists for our clients. And, clients get nervous when things are probably the best time to buy and they want to sell. And most clients want to buy when everything's kind of bubbly at the top. And so I think it's our job as financial advisors. And that's why I think having a financial advisor is such an important kind of like key person to have in a client's life, because we can like moderate those mood swings. And I don't mean to be Pollyannish about it, but the reality of it is, most people, if you look back over time, will tell you the best time to buy was when people didn't want to buy anything. And the worst time to buy is when everyone was buying. And so our job is to make sure we stick to the fundamentals of asset allocation, stick to the fundamentals of investing, go back to the basics of why you invest, and then how do you allocate properly? And I think in the new world of investing paradigms, it's you have to have money in equities, you have to have money, probably some in fixed income if rates stay high or go higher. And then alternatives is that little bucket that you have out here that's bigger than 3%, And I think many of our, not all of them, many of our advisors kind of follow that school of thought. And when it's laid out that way, a client, I think, will make the rational decision. It's like, yeah, I think that does make some sense. And then we have to perform, right? I mean, I go back to this whole word of evidence. You have to demonstrate You have to provide evidence that you can perform. And so, I think that's how we lay it out. For the wealthier clients, it's a little bit less of an issue because sometimes they have so much money, liquidity is nothing for them. In fact, as I said earlier, they get tired of liquidity. So they're okay throwing a chunk of their assets and things they don't want to mark to market. And they're very comfortable in seeing where it ends up in 15 years from now. Clients don't care about liquidity until they say, I need liquidity. And so you just never know that when that point comes as well.
As you stratify that client base across the ultra high net worth, the high net worth, the mass affluent, how different are the asset allocations today?
Sticking with this theme of alternatives, the further you go up the kind of wealth curve, the significantly more alternatives are in there, okay? Either through us or them doing it on their own, by the way. And so as we allocate, capital to these types of programs, you'll see our wealthier clients have a larger percentage, more than 8% usually, to the alternative space, more heavily focused on private equity than hedge funds. That's been a flip, by the way. Hedge funds, 15 years ago, that was all hedge funds. Now it's mainly private equity. And as you go down, it's a much smaller number. But those clients in that kind of high net worth, let's say $1 million to $10 million range, are trying to find ways to have access to the alternative platforms. And that's where you go into the perpetual funds and the daily liquidity funds and, trying to gain a little bit kind of non-correlated, if possible, returns on their investments. And I think, sometimes going through a market kind of gyration that we're going through, I think it's going to make everybody rethink it. And I call it the reset. I think long-term, the markets are going to continue to perform. This is another kind of like glitch, like we go through every 5 or 6 years or so. But there's always a little reset. And as I tell our advisors and our clients all the time, listen, why not use this as an opportunity to sit down and maybe reset something? Maybe we tweak the portfolio based on the new paradigm that we see happening. Not a knee-jerk reaction, but a longer-term view. So, that's why I'm very optimistic about the role that alts play in our clients' portfolios. And I've been a proponent for 15 years about this stuff, and I think it's going to continue to grow.
I'd love to ask you about alignment. And you have the UBS business, you have all these different advisors, you then have their clients, and then asset managers, and in particular alternatives. That's been a big issue for a long time. How do you think about the different layers of where incentives lie?
We try to be completely agnostic. I go back to what I said earlier. Best possible solution for the best possible price for our clients. And we've set up the platform to where, if you want to go in and charge whatever the fee is on let's say the private equity fund that's listed on our platform, you can charge that private equity whatever the upfront fee, if there is one, and whatever the annual management fee. Or if you want to, we have a capability here where you can go in on an institutional pricing level and charge a client an advisory fee, no other fees. So think about separating the cost of manufacturing from the cost of distribution or advice. By the way, that's the fastest growing platform we have here right now, where advisors want to say, Mr. and Miss Jones, instead of me buying this the traditional way, I'd rather buy it in a more institutional way, but I'll charge you an advice that's totally separate. So that way we're on the same side of the table. In case the fund's not working, we can exit it right away, and I'm only working for you. So it's you're separating the cost of your advice from from the machine or from the factory. And that's how many of our advisors today are recommending alternatives to their clients. And so, but at the same time, we're a completely transparent place. So any fees that are involved in any of the products are transparent to our clients. And so we want them to be fully informed on what the cost is, whether it's that way or this way, and we give them optionality on how they want to invest in these programs. And, our partners, I think, are really good about this, our private equity partners and alternatives partners. I mean, if we tell them we need to change the way that they're pricing something, and, we're a big buyer, we're somebody that they look to, they'll usually entertain whatever we have to say.
Then if you take that up a level of the advisors and their relationship with UBS, there's long been a history of, as you said, the onset, advisors as independent contractors. And sometimes there are deals and they take their book of business and they move to a different bank and then they move back and they're back and forth. How has that played out over the years?
My view is real simple. If we can't create the best platform for them to operate on, then they should probably leave. And so my job, probably more than anything, is to work with partners like Jerry Pascucci and Solita Marcelli, who's our CIO, and everyone else in the organization to make sure we build the best platform for them to serve their clients. I mean, that's it. In the United States, when an advisor leaves from one firm to the other, they typically take around 80% of their clients with them. When we hire an advisor from another firm, we typically get 80 or more percent of their clients with them. Sometimes those numbers change a little bit, and it's just, I think it's it's like normal course of everyday business. I hate it, don't like it. I wish everyone would stay here. But my view is, listen, our job is to build the best platform for them and their clients. And sometimes clients say, I don't want to leave. I like it here. I've got good stuff. And so that's refreshing, by the way. But I respect the financial advisor. I respect what they do. I view my role as a partner with them. And if they think they can do it better at another place, I wish them well, So the attrition numbers aren't as high as people think. It's a small percentage every year, annually, of the overall business that we have, actually smaller than what anybody would guess. And but they're headline grabbing sometimes. And if you're a client, it could be, aggravating. It's like, I got to move. What, I have to sign paperwork. I don't think clients like it at all. But sometimes advisors think they can serve their clients better. And, if that's the case, fine. But I'm myopically focused on making sure our platform here is the best that any advisor can choose from.
Now, alongside the demographic shift of the boomers and the wealth transfer, there's also this question about the demographics of advisors. Plenty, like you, have been in the business for multiple decades. It seem like there are fewer coming up. How have you thought about that from your business perspective?
When I started, everyone was a sole practitioner. Everyone worked on their own. And then you started seeing people team up for a lot of different reasons to serve clients better, to, maybe give them some more time off, to run a more professional business. Clients were demanding it. Clients would say, what happens if you're not in, Ted? Who do I talk to on the phone? So we went from being a sole practitioner business. And then in the late 90s, people started teaming up where almost everybody's on a team. Like, I gave you the number earlier. We have very few sole practitioners at our firm any longer. But the big transformation that happened, I'd say, really COVID's what accelerated it, was those teams, unfortunately, look like me and you, 3 or 4 55-year-old white guys in the room. There was no diversity of age. There was no diversity of gender. And there certainly wasn't any diversity of ethnicity. I mean, our industry's done a poor job in that area. And so what you've seen accelerate in the last, I'd say since 2019, I've been, speaking about this at every presentation and speech I give. It's about your teams have to start looking like the clients you serve, or they have to start looking like the world we live in. And that's not 3 middle-aged white people. It's, do you have diversity of gender? Meaning, who's going to talk to the women in the equation? You realize right now women control about 33% of the wealth of the United States. In 7 years, they're going to control over 50% of the wealth in the United States because of this baby boomer phenomenon I'm talking about. So the patriarch passes away, the money's passed over to the surviving spouse. Most of the times it's a woman. And if there's no woman involved in the discussions, they just look at you and say, okay, I'm going to go work with the team that's got women on the team. And so most of our teams now have diversity of gender on their teams to make sure that we serve our clients the way they should. And now we're really working on diversity of age. I mean, I tell people this with this whole wealth transfer, it's not about Gen 2. Gen 2 is just under the baby boomer time frame. It's really about how do you keep Gen 3. So Gen 1's in their 60s and 70s. Gen 2 is in their 40s, maybe late 30s. And it's the Gen 3 that has no interest in dealing with a financial advisor whatsoever because they do it on their phone. How do you connect them to the organization? And so you'll see most of our teams now, and they have an insatiable demand, is how do we find junior people to join our teams to provide that connection all the way through the family tree, from patriarch down to Gen 3. We have a thing called the Wealth Advice Center here at our firm. They now work with smaller accounts. They work in a highly kind of controlled environment where we teach them how to have personal skills on the phone, how to talk to clients about asset allocation, how to talk to them about investing money. And that becomes the incubator or the kind of the growing area for these young advisors, for our experienced teams to hire from. So the goal is It's not the old days like you just go hire people and say, there's a telephone, cold call. Can't even do that any longer, right? We actually home grow these people in the organization, working on existing UBS relationships that are smaller. Sometimes they become bigger because they do a good job. And they become eventually the training ground for our teams to pick up to be their junior partners. The success rate has been really promising, and I'm personally super excited about it because that was a hole in our industry. It's like, how do we find that next level of talent? Because you have to grow a business in non-traditional ways now. And so here's a way we can just integrate them on the team immediately. The teams are, I gave you the revenue numbers earlier, are sizable enough to help, co-invest in these people. And my goal is in 5 years, they'll be full partners on the team and they'll cover one segment of the overall business. And so, long answer to your question, but went from sole practitioners to just teaming for teaming's sake. And now the teams are trying to, evolving to look more like the world that we live in.
One last question before I want to ask you a couple of fun closing questions. You were sitting atop the largest wealth manager. In addition to some of these initiatives, how do you think about making sure that you stay at the top and continue winning?
Well, it starts with clients first. I mean, I literally think that if everything we do is focused around clients, then everything else is going to work out. So personally, I spend a tremendous amount of time understanding markets, understanding demographics, understanding wealth, what people need, what they're asking for, how to help them professionally and personally. And then that translates to financial advisors, is how do we become the best partners we can be for our financial advisors? Once again, I view them as a partner. And so to build them the right platform, and if we continuously strive and challenge, and if we continue to push ourselves, we'll have the right capabilities and product sets for our advisors to be super successful. So that's how it starts with the client. It's partnering with the advisor. It's never being afraid to listen to a suggestion. By the way, no suggestion's stupid, by the way. They're all good. We can't implement them all. The second I lose that is the second we go the other way around. I tell people all the time, it's the two things that I see that bring people down or businesses down or countries down, you name it, is ego and arrogance. If you think you're doing great and your ego gets really big, it usually turns into arrogance. And when it turns into arrogance, the end is near. You just don't know when. It's coming. And I've seen it happen throughout my career. And so I try to check my ego at the door. I hope I don't have arrogance. If I do, I hope people call me out on it. And I think if I continue to work with that and have people around me, like the people in this room, think the same way, like no ego, no arrogance, let's just go get it done, you usually have pretty good business.
All right, John, a couple last questions. What is your favorite hobby or activity outside of work and family?
Anything outside. I like to be in the outdoors. I'm an avid fisherman. Don't do it as much as I used to, but I love to saltwater fish primarily. I love to play golf, and I love to hike. My wife and I love to go on hikes. We have a place in North Carolina in the mountains, and just being out in nature is like, to me, it's like a great detox. It's like changes the world. I get to energize myself, and it's what I try to do every weekend. Like every weekend, I try not to work if I don't have to. I try to do one of those three things, and then I come back on Mondays supercharged to tons of energy.
What was your first paid job, and what did you learn from it?
I grew up in a small town called Ocala, Florida. Probably never heard of it. And my first paid job was my neighbor asked me to paint his house from top to bottom on the outside. And I said, sure, how much are you going to pay me? And he goes, we'll think about that at the end. He didn't tell me that I was going to have to use a paint scraper or whatever you could to scrape the old paint off the eaves around the roof. It was one of the hardest jobs I've ever done in my life. It took me 3 months to paint the entire house. But it was one of the most fulfilling things I've ever done. It was like, I learned hard work. It was hot, it was like, and he would come out and inspect me. And at the end, he paid me incredibly well. I had more. I mean, it's like I couldn't believe what he paid me. And then, as many times as I wanted to quit doing that, and as probably as many times as he wanted to fire me, he kept hiring me back. And I think it taught me a little bit about hard work and dedication. And I don't want to paint another house from top to bottom, but it was a good starting point.
How's your life turned out differently from how you expected it to?
Oh, well, at the beginning of this, I said I'm the accidental executive. I truly believe that. I mean, I'm honored and, to lead so many great people and be part of a great organization. But I never thought it was going to be this way. I thought I was going to be living in that small town that I mentioned earlier, and I'd maybe be a stockbroker in town or maybe be a lawyer in town. And here we are at Midtown Manhattan talking from my office. I would have never expected it in a million years. And maybe sometimes I still don't believe it. And maybe that's why I work so hard to make sure that I don't, disappoint what I've already done, because once again, I never thought I'd be in this position. In fact, at the end of this, I may be a financial advisor again. I love that part of the work so much. And so, yeah, it's the accidental executive. And it's been the people that I've met globally in the U.S., from all over the United States of America, not just New York. It can be in any city. They're all great. All the cities are great. And I've met so many great people. It's just been, I'm so lucky to have lived this life up until this point.
What's a mystery you wonder about?
Landing on Mars. There's a lot of talk about it these days, but I'm really fascinated about, can we actually get there and live there? And I've seen movies about it, but I'm really fascinated about it. Like, can we actually live on Mars? And I guess we're going to find out here in a few years, maybe.
So, yeah. All right, John, last one. If the next 5 years are a chapter in your life, what's that chapter about?
It's all about having a positive impact on people, not just professionally, which I'm involved with so much of the time around here, but more importantly, personally. I mean, at this stage of my career, it's all about how much I can give back to help people do things better in their lives. And if I can tweak one little thing or help them think a little bit differently, and it impacts them professionally, but more importantly, personally, that's a pretty good chapter of my book. So,
John, thanks so much for sharing this super interesting platform you're sitting on top of.
Ted, thank you. It's been great. Great seeing you.